Myth versus reality. The truth about prop firms. Prop trading firms or funded trading companies have become increasingly popular among aspiring retail traders looking for capital, but they're also surrounded by misconceptions and exaggerated claims. When you first hear about retail prop firms, it almost feels like you've stumbled onto a cheat code. Trade six figures without risking your own money. Keep up to 90% of the profits. Scale up to $1 million in trading capital. It sounds too good to be true, and in many ways it often is. From promises of instant wealth to fears of scams, the narrative around prop firms often strays far from reality. While some traders view these firms as golden tickets to financial freedom, others dismiss them entirely as too good to be true. The myth versus reality gap is one of the biggest sources of confusion and disappointment for beginner traders. If you go in believing the myths, you'll likely waste time, money, and emotional energy. But if you understand the reality, you can make informed choices and use prop firms with your eyes wide open. In this lesson, we'll separate fact from fiction, examine the most common myths about prop firms, and reveal what you really need to know before committing their time and money. Myth number 1. Prop firms want you to succeed. The myth. Prop firms market themselves as partners. The idea is simple. If you win, they win. If you make money, they share in your success. Your goals are aligned with theirs. On the surface, this makes sense. Why wouldn't a company want traders to be profitable if they're supposedly funding them? The reality. For many retail prop firms, the primary revenue stream is not trader profits. It's challenge fees. Around 90 to 95% of traders fail their evaluations and don't progress to funded accounts. Each failure means the firm keeps the challenge fee. Even traders who pass often fail later and need to buy another challenge. This means a firm can be profitable even if 100% of traders fail. While some firms do benefit when traders succeed, the business model itself does not require widespread trader success. In fact, too many successful traders would create a liability for the firm. Reality check. Prop firms don't need you to succeed. They just need you to try. Myth number 2. Anyone can get funded. The myth. Social media is full of payout screenshots and traders showing off their funded trader certificates. It gives the impression that passing a challenge is common. Most traders who try eventually get funded. It's just a matter of persistence. The reality. The actual pass rates are shockingly low. Data from firms and tech providers suggest only about 5 to 10% of traders pass an initial evaluation. Of those who pass, many lose their funded account within the first few weeks. The percentage of traders who consistently receive payouts is closer to 1 to 2%. So while it's not impossible, it's far from common. It's a bit like professional sports. Lots of people play basketball, but very few make it to the NBA. Reality check. Getting funded is not the norm. It's the exception. Myth number 3. The rules are fair and realistic. The myth. When you read the marketing material, the rules look straightforward. Hit a profit target, say 8%. Don't lose more than a set percentage per day, say 5%. Trade for a minimum number of days. It seems straightforward, like a fair test of trading skill. The reality. The fine print tells a different story. Many firms add rules that tilt the game against the trader. Daily drawdown limits punish even small mistakes. Profit targets force traders to be aggressive. Time limits push traders to overtrade. Restricted strategies, e.g., no news trading, no holding overnight, remove flexibility. Some rules are even vague, allowing firms to disqualify traders at their discretion. Reality check. The rules are often designed to maximize failure, not fairness. Myth number 4. Funded equals you're trading the firm's money. The myth. The big selling point is that you're trading real capital that belongs to the firm. This makes it feel like the firm has skin in the game. The reality. In most cases, funded accounts are simulated accounts. You're trading in a demo environment. The firm may or may not mirror your trades into live markets. Payouts often come from other traders' challenge fees, not actual market profits. This doesn't mean payouts aren't real. Many firms do pay, but it does mean you're not actually moving around the firm's $100,000. It's virtual capital with strict boundaries. Reality check. Funded accounts are usually demo accounts with payout agreements. Myth number 5. Success stories represent the average.
The myth.
Ads highlight traders who pulled $10,000 plus payouts in their first month. YouTube interviews feature million-dollar funded traders. The impression is, these outcomes are common. If they did it, you can too.
The reality.
Success stories are outliers. Firms spotlight them because they inspire more signups. For every big payout, there are thousands of failures. Most funded traders never see a single payout. It's the same tactic lotteries use, show the winner, not the millions of losers. Reality check. Success stories are marketing tools, not realistic benchmarks. The casino analogy. Think of prop firms like casinos. The casino wants you to play. It doesn't matter if a few players win big since the house edge ensures most lose. Winners are advertised, jackpot $1 million winner, to attract more players. Similarly, prop firms want you to take challenges. A few winners don't hurt. They attract more customers. The majority of traders fund the business through failures. This doesn't mean you can't win. It just means the odds are tilted against you. Why the house always wins. The design of these challenges ensures the odds are stacked against the average trader. Strict drawdown rules eliminate traders even if their overall strategy is profitable in the long run. Time limits pressure traders into overtrading. Profit targets demand aggressive risk-taking, increasing the chance of failure. In short, the evaluation rules create a funnel where only a small minority reaches the payout stage. And when one trader earns $2,000, it is funded by the fees of hundreds of others who failed. The casino habit loop. One of the most dangerous aspects of the funded account model is the low cost of entry. For as little as $50, a trader can purchase an evaluation tied to a much larger notional account, say $5,000 or $10,000. This tiny initial commitment radically changes the way traders behave. When the cost of participation is so low, traders adopt behaviors identical to gamblers. Fast failures. Blow the account within minutes or hours by taking oversized risks. Immediate re-entry. Buy another challenge, rationalizing that it's just another $50. Repetition. Repeat the cycle multiple times a week, or even multiple times a day. Over time, this becomes less about trading and more about gambling. The cheap entry creates a perception that losses are inconsequential, which erodes discipline. Why these myths persist? Psychological appeal. Traders want to believe there's an easier path. Social media hype. Success stories spread faster than failures. Firm marketing. Highlighting big payouts is more attractive than publishing failure rates. Trader denial. Many think, others fail, but I'll be different.
The reality, summarized.
Prop firms are not your business partner. They are selling you a product. Access to a challenge. Success is possible but rare. Passing a challenge and staying profitable in the long term is extremely difficult. The rules are stacked in the firm's favor. They are designed to limit payouts. Funded accounts are often simulated. Payouts are real, but the capital itself may not be. Success stories are exceptions, not norms. For most prop firms, their primary business is selling the dream of getting funded, not the actual business of funding traders. The profit split is just the prize for the few who make it through the system. Key takeaways. The glossy promises of prop firms hide a much harsher reality. Most traders will never get funded, and even fewer will receive consistent payouts. The business model depends on challenge fees, not trader success. If you approach prop firms believing the myths, you'll likely get burned. If you approach them knowing the realities, you can avoid common traps. We've now seen the myths stripped away and the reality exposed. The next logical question is, how do prop firms actually stay in business if most traders fail? In the next lesson, we'll dig into the prop firm business model and break down exactly how these companies make money.